Welcome to the deep dive. This is where we take a stack of compelling sources, pull out the most important nuggets of knowledge, and really help you become truly well-informed. Today, we are plunging into the world of e-commerce. Specifically, we're focusing on a giant that's, well, both celebrated and maybe a bit scrutinized, Shopify.
Definitely gets a lot of attention.
Yeah, and we're pulling insights mainly from a really thought-provoking article. It's titled Shopify, Growth Stock or Overvalued Investment.
Classic dilemma.
Exactly. It gives us this detailed look at their current performance, their, future potential, but also some pretty serious valuation challenges.
Right.
So our mission today is to unpack why Shopify has seen such, explosive growth, look at the innovative new tools they're rolling out, and crucially, what do the cold, hard numbers say about its stock valuation right now?
And what's truly insightful here, I think, is that we'll explore a business that's undeniably strong. It's growing. It's got impressive market dominance.
No question there.
Yeah, but the investment picture, it's just not as straightforward as you might think. So this raises a really important question, I think, for all of us. Can a fantastic business still be a tricky or maybe even a poor investment if you buy it at the wrong price?
That's the core of it, isn't it? We'll really dig into that paradox. Right, so let's dig into this fascinating disconnect then. The article throws us right into it. Shopify stock has doubled in the past year, soaring over 100%.
Incredible run.
Incredible run, yet it's still trading 15% below its all-time peak.
Still hasn't fully recovered from that high.
Exactly. It's like watching, a high wire act where the performer climbs, falls back a bit, then climbs again, but hasn't quite reached the very top platform yet.
Yeah, that's a good analogy.
And this resilience, after what the article calls a brutal drawdown in 2022, that was following the whole COVID-19 bubble, right?
Right, that period where so many tech stocks just went vertical and then, it came back down to earth.
Came back down hard. So this whole wild ride, what does it tell us about, market sentiment versus the actual health of the business?
Well, if we connect this to the bigger picture, it really highlights how market sentiment, fear or euphoria, it can sometimes just detach completely from the underlying business performance.
Gets ahead of itself or behind.
Exactly. The article points out that despite the stock's roller coaster, Shopify's actual business performance has been, and I quote, rock solid, if not stellar.
Rock solid. Okay.
So that suggests this recent stock surge is, partly a reflection of the business consistently delivering the goods and partly just a recovery from that market overcorrection we saw.
Okay, so given that rock-solid performance, what are the core elements driving this underlying business strength? What's making it tick?
Well, a big part is just how much they've grown to dominate the North American market. They're really the go-to software and payments provider for online businesses, from the smallest startups right up to pretty significant enterprises.
Right, they cover the spectrum.
They do. And now they're pushing aggressively into international markets. Just last quarter, their European division saw this really impressive 42% growth in payments volume.
Wow, 42%.
Yeah, and that actually outpaced their overall growth rate. So it signals really strong traction in these new markets.
And they're clearly landing big fish too, right? The article mentions even Starbucks signed a deal with Shopify. That's a huge endorsement.
It is. It really shows the capabilities of their platform for, serious online shopping operations.
But does the article suggest maybe Shopify is at risk of spreading itself too thin, catering to everyone from a tiny startup to a giant like Starbucks? Or is this seen as a strength?
That's a great question. The article really frames it more as a testament to their platform's flexibility rather than a risk.
Okay.
Their ability to serve both, a brand new entrepreneur and an established global brand like Starbucks, adapting to different scales, different needs. That's precisely one of their big competitive advantages.
Gotcha. So flexibility is key.
Definitely. And the core numbers, they really reinforce this strength. Overall revenue grew a pretty robust 31% year over year last quarter.
31% year over year, still very strong.
Very strong. And they expect strong growth for the rest of the year, too. Plus, profit margins remain strong, which means they're efficiently turning that revenue into profit.
Good sign.
And their free cash flow margins were an impressive 16% in the quarter. That free cash flow, that's the actual cash the business generates after all its expenses are paid.
The real money left over.
Exactly. It gives them flexibility for innovation or, weathering tough times. So this combination of strong growth and robust cash generation, That's a key reason the stock has soared recently.
Okay, so beyond just the raw numbers, it seems like what's really powering Shopify's, let's say, long-term potential is this relentless innovation. The article dives deep into how they're not just expanding geographically, but also pioneering with new tech like AI and even cryptocurrency. What are some of these features keeping them ahead?
Well, they've launched 2 new artificial intelligence services. They're called Sidekick and Magic.
Sidekick and Magic. Okay.
And these aren't just buzzwords, right? They're designed to actually help businesses automate tasks. Things like analyzing sales trends, drafting marketing content, even helping with customer service.
So practical tools.
Very practical. Imagine a small business owner using AI to instantly generate product descriptions or figure out the best pricing strategy. Providing that kind of extra value keeps customers really deeply entrenched in the Shopify ecosystem.
Makes it harder to leave. And on the payment side, stepping into crypto, that feels like a bold move.
It is, yeah. Shopify is now starting to accept Circle's stablecoin, USDC, as a form of payment.
Okay, USDC, so that's a stablecoin, pegged to the dollar, right?
Well,
Less volatile.
Exactly. It's designed to maintain a stable value, unlike, say, Bitcoin. And this is pretty significant because it can really help facilitate cross-border transactions. You potentially reduce traditional currency exchange fees.
Oh, interesting.
And it just makes it easier for shoppers who might prefer to pay with different methods on Shopify's storefronts.
So it's not just about accepting crypto for crypto's sake.
Not at all. This could genuinely drive new payment growth, which, directly translates to revenue for Shopify. But it also encourages more shopping across borders, expanding their reach even further.
So it really sounds like they're building this massive kind of comprehensive ecosystem of products for online businesses. The article even boldly states their breadth of tools is unmatched in the software world.
Strong claim.
It is. But is that truly the case? I mean, are there any hidden downsides or maybe potential competitive threats to this whole ecosystem approach? Or does Shopify genuinely have a unique moat here?
Well, the article makes a pretty compelling case for their uniqueness. Sure, competitors exist for individual tools like email marketing or whatever, but few, if any, offer such an integrated suite.
All under one roof.
Right. The potential downside.
Yeah.
Maybe complexity for brand new users, but their AI tools seem designed partly to mitigate that. Their real moat, I think, comes from the network effect they've built.
Explain that.
Well, the more merchants use Shopify, the more developers want to build apps for the Shopify App Store, the more services integrate with Shopify, which then makes it even more attractive for new merchants to join.
It feeds itself.
Exactly. It's a really powerful cycle.
Okay. So we've painted this picture of a robust, innovative company, impressive growth, wide-ranging ecosystem. Seems great.
On the surface, yeah.
But as our article asks, and this is a direct challenge to every potential investor, should you buy Shopify stock?
The million-dollar question, indeed.
It really is, because it's a crucial pivot. As we know, even a rapidly growing, fantastic business isn't automatically a sound investment, is it?
Absolutely not.
So what are the key arguments the author presents against hitting buy right now?
Well, the article highlights that while Shopify's total revenue is substantial, about $10 billion over the last 12 months.
Which is huge. It's huge.
Yeah.
And revenue growth is expected to stay strong, over 20% for the rest of 2025. But that kind of explosive growth just cannot continue indefinitely as a company matures.
Law of large numbers kicks in eventually.
Exactly.
Right.
There are simply limits to how large any company can get while maintaining those super high growth rates.
Okay, so what does this tapering growth, even if it's still strong, mean for its valuation today?
Yeah.
Especially after that huge 100% stock run we talked about earlier.
Right. So the author does some projections. They figure, okay, let's say Shopify's revenue grows at a still impressive average rate of 15% for the next 5 years.
15% average.
That would get them to about $20 billion in revenue by 2030. Then you have to make some assumptions about profitability as they mature. Let's say they reach a healthy 50% gross profit margin.
Meaning half the revenue is left after the cost of goods.
Right. And maybe a strong 20% net income margin, so 20 cents of profit left from every dollar of revenue after all expenses.
Okay, plausible, mature margins. Plausible, yeah. So that $20 billion in revenue would translate to about $4 billion in annual net earnings 5 years from now.
$4 billion in net earnings by 2030. Based on those assumptions. And how does that stack up against its market cap today, its total value on the stock market?
Well, today, Shopify has a market cap of around $187 billion.
Wow, okay. Big number.
Very big number. So to put that in perspective, based on those projected earnings of $4 billion in 5 years. The stock would be trading at a forward price-to-earnings ratio, or PE, of 47.
A forward PE of 47 based on earnings 5 years out.
Correct. And for context, a PE of 47 means investors today are willing to pay $47 for every $1 of projected annual earnings 5 years from now. That's significantly higher than many mature, highly profitable companies. It suggests a tremendous amount of future growth, and profitability is, well, already priced into the stock today.
So the market is already assuming not just the growth, but near-perfect execution for years to come.
That seems to be the implication. And the author's conclusion is pretty strong because of this. They say, quote, "Despite how good of a business it is, this nosebleed PE ratio means investors should avoid Shopify stock after its recent 100% run over the last 12 months.
Nosebleed PE. Yeah, that's a pretty vivid way to put it. Makes your eyes water just thinking about it.
It certainly gets the point across.
It's almost like, I don't know, falling in love with a dream car, seeing all the amazing features, and then you look at the price tag and realize you're paying a massive premium for a future version that hasn't even been built yet.
That's a fair comparison, I think. It really is a fascinating look at how a truly innovative, genuinely growing company can still present a really complex investment decision.
Yeah.
And what's truly insightful here is how Shopify's journey perfectly illustrates this classic market trap, doesn't it? Even an undeniable business success story like that 42% growth in European payments we mentioned.
Right. Objectively good news.
Objectively great news. But it can become a questionable investment if all that future potential, and then some, is already baked into its current stock price.
So it's a powerful reminder that growth alone just isn't enough. The price you pay for that growth is equally critical, maybe even more critical sometimes.
Couldn't agree more.
So the core takeaway here isn't just about Shopify, is it? It's really about our own investment psychology. It makes you think, how often do we let the allure of a compelling growth story, blind us to the harsh realities of valuation?
Getting caught up in the hype.
Exactly. Leading us to potentially buy yesterday's amazing news, but at tomorrow's maybe optimistic price. It's a critical question, I think, for you to consider with any exciting company you look at.